The spread of coronavirus, COVID-19, beyond China has created fresh uncertainty for the global growth outlook and sparked volatility in financial markets. Outbreaks in South Korea, Iran and Italy have raised concerns that the spread outside of China may be accelerating. We offer key facts on the spread of the virus, interspersed with views from senior Schroders economists and fund managers. What has been the impact so far? The human impact has been significant, with more than 2,800 deaths now confirmed. February 27, the majority in Hubei province in China. This is far greater than the Severe Acute Respiratory Syndrome (SARS) outbreak that killed close to 800 people in 2002 to 2003. Chinese authorities have reacted by enforcing quarantines, as well as restricting public gatherings, travel and tourism. From a financial markets perspective, the response had been fairly muted amid signs that the rate of infection in China had peaked. However, the recent emergence, and acceleration, of cases in South Korea, Iran and Italy has led to fears that the virus could have a far greater impact than markets were initially anticipating. The charts below show how stock markets have been hit while demand for bonds has risen, which has the effect of pushing down yields and increasing prices. After an initial rebound, global, MSCI World Index, and mainland China markets have seen renewed falls. Among other markets, commodity prices have also felt a disproportionate impact. China is the dominant consumer of many raw materials, particularly metals for use in industry. As a result, the impact on prices has been significant, as illustrated by the S&P GSCI, a measure of broad commodity price performance. This has implications for countries which are commodity exporters. Latin America, in particular, Brazil, Chile, Colombia and Peru have all seen marked volatility in their equity markets and currencies. Commodity prices fell sharply as the severity of the outbreak escalated. Why is this outbreak different to previous incidences such as SARS? China's place in the global economy has changed dramatically since the SARS outbreak. As Schroders economist Azad Zangana recently wrote, China represented 4.2% of the global economy in 2002 and contributed 18% to world GDP growth. By 2018, its share of world GDP had risen to 15.8%, with 35% of global growth coming from China, as highlighted in the chart below. The impact of weaker economic activity in China will therefore have a proportionately greater impact on overall global growth. After a year in which US-China trade tensions weighed on global growth, market expectations were for an improvement this year. This was predicated on the improvement in trade relations between the two sides over the fourth quarter of 2019, culminating in the signing of the so-called Phase 1 trade agreement on the 15th of January. The coronavirus outbreak has cast significant. For more on this story, visit the news article link.